Now that our first tax season under the new Tax Cuts and Jobs Act is behind us, we've certainly learned some lessons. My name's Elizabeth Wilson, and I'm the VP of Finance and Tax Services here at Valley National Financial Advisors. Myself and my fellow CPA colleagues would like to share some tax planning strategies with you that we can use to assess your 2019 tax situation and use in future years as well. You may have been surprised last spring when you reviewed your tax return and didn't have quite the refund that you expected, or possibly even owed more money. That's why we want to share these tax planning strategies with you.
When filing your tax return, you have the option to claim either the standard deduction or itemize your deductions. For 2019, the standard deduction is $12,200 for single filers and $24,400 if you're married filing jointly. Many people will find that they will claim this higher standard deduction due to the limitations on the itemized deductions. Starting in 2019, medical expenses are now limited to 10% of your income, as opposed to in the prior years where it was only 7.5% of your income. In addition, the real estate tax and the state and local income tax or sales tax is still limited to $10,000. If you find yourself close to the standard deduction, you may want to consider a strategy called bunching. This is where you will accelerate some of your 2020 expenses into 2019, so that way you're able to claim the itemized deduction and save the standard deduction for the next year.
We're in November 2019. It's been a pretty good year for investment portfolios. So most of us right now are probably looking at net realized gains in our portfolios. So from a tax planning perspective, if you have net short-term gains, those are taxed at whatever your marginal tax rate is. The benefit of having net long-term gains is there's a special tax rate that applies. So typical year-end tax planning is you look at your portfolio to see, are there any losses I can take, particularly to net out to zero my net short-term gains. So we're not paying any tax at our highest tax rate on those net short-term gains. If we end up with net long-term gains, that's not necessarily a terrible thing, but if you have losses in the portfolio that you can take before the end of the year to reduce the net long-term gains, that's a great thing as well. On your dividends, not a lot of planning related to dividends. The important thing to be aware of there is that qualified dividends are eligible for special tax treatment.
Talking about tax planning, we can't ignore something called required minimum distributions for those people who reach age 70 and a half or otherwise might be required to take a distribution from a retirement account because of an inheritance. So at age 70 and a half is your first required minimum distribution. Now the IRS gives us an option. In that first year we reach age 70 and a half, we can take it out then, or they give us until April 1st of the year following the year we reach age 70 and a half. It gets a little crazy. The trouble is that some people don't realize, they think, oh, I'll just wait till April 1st of that year following, but then the IRS tells us we have to take two. So that's why we want to be careful in our tax planning and understand the implications of when we're taking our required minimum distribution. The other thing that happens though at age 70 and a half is the IRS also allows us to do something called a qualified charitable distribution. So if you're charitably inclined, we can also use your required minimum distribution to fund some of your charitable giving, and then we don't have to recognize that in our income.
A good tax tip is to contribute up to $19,000 into a 401k plan, or up to $25,000 if you're age 50 or older. If you clear the Social Security wage base of $132,900 for 2019, and you immediately take those tax savings and defer additional money into your 401k plan, you can actually increase your deferral without any change and reduction to your take-home pay. Another strategy is to establish a Section 529 plan earmarked for a child's college education. Section 529 plans, the contributions to them may be tax deductible on your state income tax return. And future distributions from these plans that are used for qualified education purposes are exempt from tax.
So I'm going to talk to you about estimated payments and tax penalties that the IRS could levy if you fall short in paying your taxes. So the IRS does require that you pay your taxes on time. You either pay through withholdings or estimated payments on a quarterly basis. If you don't pay the correct amount of tax for the tax year, the IRS could levy an estimated tax penalty. The penalty can be avoided by paying in enough tax to cover the safe harbor rule. The safe harbor rule says that if you pay enough withholding and quarterly estimates in that cover 90% of your tax liability for the current year or 100% of your previous year's tax. Now, if you make $150,000 in AGI in a year, that safe harbor rule is then 110% of your tax. It's easier to figure out your estimated payments based on your previous year's tax of 100% or 110% if that's where you fall under. If you find yourself not having enough withholdings or estimated payments in for 2019, it would be a good idea to contact your tax preparer.
There is still time to take advantage of these tax planning strategies in 2019. If your circumstance has changed throughout the year, or you're expecting a change in circumstance for next year, give us a call so we can talk about where you stand.